So, for these next slides here, ideally you should have gone through these and actually try to solve them as best as possible before looking at this, because you have all the information required to do so. But let's go through them and make sure it's nice and clear. So initially the government budget is balanced and trade is balanced. It didn't have to be balanced. All that we're saying here is that now the government runs a budget deficit. So this would have been the case as well if we had a small budget deficit and it's now growing a bigger budget deficit. The reason why we kind of start from this balance to this budget deficits approach is it just makes it easier to understand that, well, initially we had taxes equal to government spending, and now we have that our government spending is greater than our taxes, running a budget deficit. But even if we had this current situation in the beginning, if we say, well, we've increased government spending without increasing our taxes and we're running a bigger deficit, it's the same idea. So as we saw earlier, R rises and NCO will fall as we run this bigger budget deficit, because as we run this bigger budget deficit, national saving, there's national saving, which is private and public saving. Well, public saving will go down, and it might be, in this case here, public borrowing. So as this public saving goes down, it leads to an upward pressure in the interest rate that we would observe domestically. We saw if we take away the fact that we're in an open economy, we still are, but that equilibrium interest rate and that loanable funds market that you could see again at the first section of this chapter, well, all of a sudden the supply would be lesser, so it would drive what our own interest rate would be as higher. And if we had a big net capital outflow initially, net capital outflow would fall. So how does the budget deficit affect the Canadian real exchange rate, the balance of trade? Well, pretty simple. If you use the Mankiw approach, essentially you could say, well, since net capital outflow falls, this must be shifting left. As this is shifting left, there's no reason why net exports have changed necessarily. The demand for net export hasn't changed, but as this shifts left, the real exchange rate is going to go up, so the quantity of net exports will go down. So once again, always with these shifts is making sure that you understand why things shift, and then it doesn't mean that since the net export curve doesn't shift that the quantity will stay the same. It's that same idea as supply and demand from microeconomics, that even though the demand curve may shift but not the supply curve, doesn't mean that quantity supplied will not change. There's an increase in world interest rates. What will happen to NCO and the exchange rate, net exports? Well, this is pretty straightforward. It's kind of the opposite now. It's the world interest rates going up, so we could expect NCO to go up. And as NCO goes up, this area here is shifting right. And as that shifts right, the exchange rate goes down. So you could kind of see it on a two-graph basis with a little bit more explanation. But overall, it's pretty straightforward. In a closed economy, a government budget deficit reduces the supply of loanable funds, drives up the domestic interest rate, and crowds out investment. What is the effect of a government budget deficit in an open economy? So this is what happens in the closed economy. And an open economy is what we saw a few slides ago, that it's going to drive up interest rates, and therefore we're going to have an increase in the value of our currency. So here's just a second way to see it. Smaller net capital outflow, smaller to the left. Once again, same kind of story. There's not a ton of stories that could be discussed. This is the one that gets a little bit more interesting in this idea of trade policy. So a government policy that directly influences the quantity of goods and services that country imports or exports. So if we introduce a tariff or an import quota, we're trying to have an impact on trade. The interesting thing to look at when we look at this, though, is when we're trying to have an impact on trade, there's nothing that changed in that capital outflow in this story. So the supply of dollars doesn't really change. The only thing that's going to change from this import quota is it's going to shift this net exports curve, and it's going to lead to an increase in the real exchange rate. So it's going to be more costly to import goods, and it's going to increase the value of our currency to a certain extent because we just can't import as much as before. So it's kind of a little bit of a counterintuitive impact that we won't necessarily import all that much less in value, but in the end we're going to have just an appreciation of our currency is going to be one of the big impacts. So trade policies do not completely affect trade balance. There's still some impact going on there, but they do alter, because they don't alter national saving or domestic investment. So for given levels of national saving and domestic investment, it's the real exchange rate that adjusts to keep the trade balance the same, regardless of the trade policies the government puts into place. So those goods will become more expensive, but overall, we're going to have a situation where it's the exchange rate that's going to adjust in this whole process as well. So just different things to keep in mind. We're going to get back at trading and the value of goods in different countries, so don't worry about this slide too much at this stage. It's really the ones before with budget deficits that seem to pop out a little bit more in some of the multiple choice questions, so make sure you understand that nice and clearly.